Nobody wants their finances to end up as a story with a bad ending, right? Running out of money or a big stock that goes bust. Nearly all of the horrible financial stories that I've heard and read about came from, in my opinion, not having the right amount of cash in regards to the assets that you own. Now, whether that's real estate, stocks, bonds, or even the ratio of debt that you hold. And you get the point. But these horrible stories were really not because the economy had a recession or a meltdown. So then, how can we help each other avoid being one of these stories? Now, if you're a client of ours, or if you've ever heard me speak, or even read my most recent book, The Currency of Time, then you know about my 3 buckets. And as founder of the Retire While You Work philosophy, these 3 buckets really serve as the foundation of a well-built long-term wealth plan. For over 20 years and meeting with thousands of families, I can attest that the key to an all-weather investment plan is having these buckets set up with the right balance and ratios. So then let's get right to it. Bucket 1 is the emergency fund, and it really should be about or at least 3 to 6 months of expenses. And then we adjust that accordingly for any additional expenses coming up in the next year, like taxes, or a car, or maybe a home renovation. And we want to make sure that you can handle any of life's surprises that happen. So again, things like a car breaks down, you need a new roof, an unexpected health bill, or maybe your puppy needs an ACL surgery. Been there, done that. And also you want to have money set aside for the known expenses that are coming up over the next year or so. Why? Well, 2 reasons. 1, we don't want to go backwards and have to use a credit card every time an emergency happens. And 2, we don't want money invested in the stock market that we need for surprises or known expenses coming up in the next year. Because the stock market is volatile over very short periods of time, but over the mid and long term, it starts to become more predictable, which is why we have buckets 2 and 3, and I'll get to those here in a minute. Back to bucket 1, being that it's short-term in nature, should really be left in the bank. Maybe a savings or a money market account, super boring, maybe making 1 to 2% if you're lucky, but it's limited to no risk. So think on a scale of 1 to 10, with a 10 being all stocks and aggressive, and a 1 being no risk. This would be maybe a 1 or a 2. Now let's fast forward to bucket 3 and then come back to bucket 2 last, because bucket 3, most of you are already familiar with, and it makes sense to address my favorite bucket, which is bucket 2, last. Okay, bucket 3. This is long-term. Think retirement accounts like your 401k, IRAs, that sort of thing. This is money that you typically can't touch to your 59 and a half, which is a weird IRS rule, but you get a nice tax savings for investing in these accounts. And I tell clients to aim for about 15 to 20% of their income into bucket 3 and invest it a little more aggressively. So think a 7 to a 10 on the risk scale, since you won't be able to touch it till retirement age. And remember, over 5-year, 10-year, and longer periods, the market historically averages much better than conservative investments like your CDs at the bank or bonds. Now, bucket 2 is my favorite and the most important. I use this with clients to save and prepare for all the life that happens between the emergencies and unexpected and the long-term dream of retirement. Don't even get me started on our country's current version of retirement. It's so broken. But you can read my book, The Currency of Time, and I'll digress for now on that topic. So I also call bucket 2 the retire while you work bucket. Living life now and doing things like traveling and making memories and experiences, saving for your dream job, maybe opening a yoga studio, writing that book, being a songwriter, retiring early, and maybe even helping a nonprofit. Now, this bucket 2 money, we don't want this sitting in the bank making 1%, but we also don't want it tied up in bucket 3 for the long term. So I have clients save here and straddle the fence, if you will, between conservative and risk, meaning that we invest it more like a 5 or a 6 on the risk scale. So, for example, half stocks, maybe half bonds. That way we target a decent rate of return if we don't end up using or needing the money. But if life happens and we need the money tomorrow, there's always some of it that's conservative that we can get our hands on in case, let's say, the stock market has a horrible year like 2008. It's like having an extension of your emergency fund that's also liquid, but it's growing closer to a bucket 3 for the long term. And over time, as your net worth increases, we start to expand bucket 2 to include things like real estate. Think your rental properties, maybe VRBOs, and also things like college savings, 529s, for example. Now, the key with my 3-bucket approach is striking the right balance between each of the buckets. And at any given time, having a balance sheet that gives you immediate access to funds, but also allows you to have money working for you long term. So let me give you a quick hypothetical example of how I would advise a client that walked into my office. Let's say with the following situation. So this client shares with me that they have about $500,000 in an old 401k, $200,000 in their current work 401k, and they also own about $300,000 of individual stocks in a brokerage account that they manage themselves online, and around $400,000 in cash. So I would start with bucket 1 and help them determine how much they really need in that emergency fund, plus any upcoming big ticket items in the next year, like maybe taxes or a new car. After that, this client explains to me that they like having about $50,000 for their 6 months worth of expenses in the bank. And their CPA says that they're likely going to owe about $100,000 in taxes. And one of them needs a new car for $50,000 in the next 6 months. And they also have student loan with about $50,000 left. So I would likely advise to leave about $250,000 in cash for now and move the remaining $150,000 into bucket 2. Why? The $50,000 emergency fund is important for life's what-ifs and any of those unexpected events. So I advise leaving the $100,000 for taxes to be safe and $50,000 for the vehicle as well, because I've learned that people usually underestimate big ticket items. Plus, if they end up not needing all of that cash for taxes or the car, we can always shift that back into bucket 2 later. And I would for sure knock out that last $50,000 of debt that they have, even if it's super low interest student loan debt. There's just no reason to carry debt if they have the cash in the bank earning less interest on the debt. Plus, it feels awesome to have no debt, all right? Now, in bucket 2, I would combine their current $300,000 stock portfolio with this new $150,000 of cash, seeking a more balanced portfolio between those higher risk stocks that they have now in that portfolio, and add some more blue chip dividend paying stocks and bonds to really balance out that portfolio. Lastly, in bucket 3, I would look at the various options available for their old 401k, and if it makes sense, help them roll over that old 401k from a previous employer into a self-directed IRA where they will have more control and options, and then help oversee their 401k with their current employer, as that needs to really stay put until they retire or change jobs. I would then ask them how much they could save each month for financial planning and allow my team to utilize that money in areas to help their balance sheet continue to grow. For this example, let's say that the client could afford to do $3,000 a month with us. I would consider something like adding $1,000 extra per month to their home mortgage to knock it out faster, and maybe $500 for each of their 2 kids into college accounts, and then the other $1,000 to keep building up their bucket 2. I would then drill down into a few other strategies, but hopefully that makes sense and you can see really how this works. Every plan we do is 100% custom, which is why I love what I do, but also it's built off of these basic principles. I could literally talk for hours on this topic, but I'll stop there and give you this advice. Contact my team and let us ask you a few questions to really understand your current buckets, and we can offer complimentary advice to find the right ratio and identify what we see as much needed tweaks. So whether you work with us or you do it yourself or even already have another advisor, it doesn't matter. This is my passion, and helping people every day keeps me showing up.